All right. Good afternoon, everyone. Thank you for joining us today for our the quarterly Cornerstone Wealth Financial and Market Update. I'm Jeff Carbone, Managing Partner at Cornerstone Wealth, joined as always by our Chief Investment Officer, Cliff Hodge, joining us from our South Carolina office today. Welcome, Cliff.
Hey, Jeff. Great to be with you. Thanks, everyone, for joining.
Hey, as a reminder, we are recording the webinar and we'll send it out. And we'll also have Ashley post it to the website for everyone to revisit, view. We hope you share it with friends, family, coworkers that may be interested in learning and hearing more about the commentary. So pass it along. You could also, when it gets posted, people can go visit our website at www.cwgadvisors.com. We've also been quite busy with other webinars. Some of you have joined us for the estate planning webinars that we've been doing. We've done a bunch on insurance, etc. So again, you can also go back to our website and visit those. As we begin today, Cliff, I've got a couple numbers going to run by you: 9, 23, 53, and 60. And don't yell bingo. So what do those numbers have in common? Or what do they mean?
Sounds like Powerball numbers I'm playing tonight.
Well, they are not Powerball, even though I may have to play these numbers. But, we've got 9 days till Veterans Day. So I'm going to first thank all those veterans, families that have had those that have served, those that are serving. I know also we've got the Veterans Day 5K coming up, and maybe I'm going to throw it to you before I move on to 23. So maybe let everybody know what's going on this weekend for the 5K run.
Yeah, thanks, Jeff. I know Ashley has sent out a couple of emails as well, but yeah, this Sunday at 2 o'clock, Cornerstone is sponsoring University of South Carolina's annual Veterans Day 5K. Again, it's 2 o'clock Sunday, downtown Columbia. We'll be running through the horseshoe on campus, downtown, where we're going to end across the street from Carolina Western Pub. There will be food, activities for kids, maybe some adult style beverages. So would certainly encourage anyone in the area, please come out. If you have any connections to USC or veterans, come support it. It's going to be a great cause. All of the proceeds go toward the Fisher House, which is similar to Ronald McDonald House in that they build temporary housing for vets and their families who are receiving treatment at the VA. So it'll be a great time. Please come if you can. And thanks again to all of our veterans and their family members for those who served.
Thanks, Cliff, for heading that up. And for our West Coast clients, USC is not University of Southern California. That is University of South Carolina. So we also have 23. 23 is a number of days before Thanksgiving. So it's coming upon us. One of my favorite times, many people, the 3 F's: family, food, and football. 53 is for the number of days until Christmas. And probably this year more than ever, shop early, because as we can see with the ports of Los Angeles, Charleston, Florida, there's some issues going on. They continue to go on with the logistics, and I know Cliff will share more of that later on. And then 60, how can it be only 60 days left until year end? So I don't know about everyone, Cliff, I don't know about you, but 2021 has flown by and it's gone too quickly, but here we are. Before, Cliff, I asked you to join and start with the market update, just kind of want to go over, there's been a lot going on. Recently, we saw Social Security increase to 5.9%, which was the biggest increase we've seen probably since the mid or early 80s. But even more importantly, as of today, again, November 2nd, still no definitive changes on the tax or estate planning front. We have seen the infrastructure package adjust a bit here. Now we're looking at about a 1.75 trillion and still talking in the trillions, down from the 3.5 trillion initially being proposed. But in that package is also the potential changes for some tax changes. First, we're looking at the raising of corporate taxes from 21% to companies to 26.5%, on companies with revenues over 5 million. We're also seeing in the package the potential increase and adding the 39.6% tax bracket for those married with income over 450,000, and for single filers, any income over 225,000 would be in a 39.6% tax rate. Still talking of capital gains increases, however, not from the original proposal, which was to increase capital gains to ordinary income tax rates, looking at about 25 up from 20% right now. A lot on the estate planning, looking at the termination of the temporary increase for unified credit, dropping from the 11.7 per person today, or 23.4 for a couple, lowering that down to about 5.6 million per person. Let's call it 10 to 12 million per couple. Part of the plan is also looking at the elimination of a few real key and big estate planning strategies I know we've used with many clients, and many clients have used them, with the grant or retained or GRATs, grant or retained annuity trust, as well as the elimination or changing of the irrevocable life insurance strategy. So again, a lot going on with the estate planning. Moving over to some additional changes for the retirement plans, we're seeing contribution limits for higher income earners could be changing. So could lower what higher income earners are putting in. Additional legislation is looking at account balances or high account balances in retirement accounts. High account balances over 10 million, there could be some additional reform that comes through. One of those could be the increase of required minimum distributions for those with high balances. That's just one thing that's being talked about. One of the things that we were watching really closely was, because we use it quite often with clients, is the strategy of what we call a backdoor Roth, where you make too much money, you can't do a contributory Roth, but you can do it through an after-tax savings way. That is looks to be off the table, so that's good news. Looks like that's been pulled out at this time. Lastly, and there's a lot of others, but one that just to talk that's been more recently put in the news is the billionaire tax. So not as many folks going to be under this, but there's about 700 billionaires in the United States that are watching this closely. And I was reading an article that the millionaires are pushing for this very, very, very hard. So that's funny. The millionaires are going after the billionaires. So interesting times. Tax and estate planning remain, key topics right now as we come out and close out the year. Make sure you're talking with your advisors, running through various strategies. I will talk with some year-end tax strategies at the end, but time is running out. If President Biden is to sign the deal, should they pass something? Let's say he's back in town next week and signs, we're under the new code. So it is a now use it or lose it situation that we're in. So thank you for bearing with me, but wanted to go through that with everyone. So Cliff, I'm going to throw it over to you. As the markets continue to hit record highs, we did see a brief pause in September, but we've got the Fed meetings kicking off tomorrow. I know you're watching that closely. Probably hear about the tapering that the Fed will look to employ here in the near future. We're seeing high, inflation rates remain high. I mentioned the logistics issues we continue to see in battle, chip issues we continue to see as issues, high valuations in the market, infrastructure, you name it. They continue to dominate the headlines right now. We're closing out on the Q3 earnings and should come to a close here in the short term. But Cliff, tell us what's going on. What did you see? What are you seeing? And what do we do about it?
I think you summed it up nicely, Jeff. There's a whole lot of nothing going on. It's never a dull moment. But I thought what we would do is first a review of what we said on the last call, provide some updates there. Then go over the outlook, as you mentioned, cover a lot of these hot topics of the day, and then finally wrap it up with some positioning as we get ready to turn the page on what's been a very eventful year. So to start off from our 2Q call, by and large, things played out as we anticipated. I would say with the one caveat that, in hindsight, which is always 2020, we were a bit early in becoming too defensive. We did get that 6% pullback in September, which lasted for all of about 3 days until we rallied back and are now back to all-time highs. So we did mention that opportunities exist for active managers. Have done well with some of our more tactical positioning, things like energy, financials, and our alternatives portfolio have done really well for us. We nailed the view on inflation. We thought that it would keep rising. That so far has been the case. One of the big questions that we're looking at and is the top of mind for investors is, what will the rate of change of inflation be going forward? So that's something we're watching very closely. And then lastly, the quality call was the right call to increase the quality in portfolios. Looking back, holding some of the cash was, we were a little early there, but given our view for the longer term, which is really what we care about and what clients are focused on, their long-term goals, we're actually pretty pleased with how things have gone for the year. So that's the rear view. Let's look forward. We're going to kind of break it down into 2 time periods. The shorter term, year end, as we'll see, there's some favorable dynamics for continued strength. However, as we said, markets are extremely disconnected from the fundamentals. Valuations are high. The Fed is about to reverse course on an ultra loose monetary regime, and we're transitioning to a growth an economy that has rebounded from the early cycle recovery phase and will now kind of wade through that mid-cycle transition. So we'll kind of look at the case for those. What does that mean for portfolios? Again, get a pound the table on alternatives. Very high conviction view for the investment team over the next 3 to 5 years. So we'll say if you have not yet had conversations with your advisor, do so, because the setup for those is good going into next year. So short term, the more bullish dynamics, markets have largely been buoyed by earnings. We've had great numbers so far. Just updated this through this morning. 324 companies. Sales are up 19% year over year. Earnings are up 41% year over year, which is above expectations. Beat rate of about 11%. Roughly 82% of companies are beating. However, we have had some pretty high-profile warnings from 2 bellwethers. Amazon, talked about supply chain issues. Apple as well, saying that it cost them roughly $6 billion for the quarter. And not just related to those 2 companies, if you look at how often supply chain issues have been mentioned, we have not seen anything like this going back to 2005. And I think this quote from Whirlpool sums up the environment pretty nicely. And we're operating in a supply-constrained and inflationary environment, which is negatively impacting most industries. However, we're on track for a year of record performance. And so that's a bit of the dichotomy that investors are facing currently with supply chains. They're 2 opposing forces, right? How long can this go on remains to be seen. Because so far, companies have done a fantastic job of navigating this environment over the short term. You can see that through profit margins are at record highs. This goes back to 1990. But the 2 can't exist in perpetuity, the 2 being record margins and the inflationary and supply chain pressures. So how much longer they can pass along these costs before it hits margins remains to be seen. However, when you do look at forward-looking estimates, by and large, expectations are beginning to come down. This is a breadth chart. So this just looks at what percentage of the S&P 500 companies are analyst earnings revisions over the next 12 months being raised or lowered. And you can see that that is beginning to roll over. and could be an issue, as we move forward. But that's more longer term. Shorter term, I mentioned some of the bullish dynamics. We looked at earnings. Seasonality is also a big one. The chart on the left goes back 20 years, looking at monthly averages. And as you can see, October through December is the best, historically the strongest 3-month period of the year. Not to say that this will always play out. I mean, clients probably remember fourth quarter of 2018. We had a sell-off, and certainly the seasonality pattern did not play out. However, there is a psychological impact, which does drive some of the results that we see on the right-hand chart, which are equity flows, right? So there's consumers, investors are still currently sitting on increased savings, even as the fiscal programs begin to roll off. But there's that psychological aspect when you think that markets may do well, you go ahead and try and get in front of it, and then it becomes a bit of a self-fulfilling prophecy. And I think that's what we saw in October, given the strength, especially here in the U.S. And then lastly, that more short-term dynamic, companies are about to unleash corporate buybacks to the tune of about $250 billion, which is going to be concentrated in November and December, according to Goldman Sachs, on over $1 trillion in buybacks for the year. And as Jeff mentioned, a lot of policies and taxes changing with the Biden plan. One that is of keen interest to the markets and to investors is the excise tax on buybacks. Currently, they're floating a 1% levy on share buybacks. This could be another bullish dynamic going into year end as corporations try and get in front of that. Go ahead and ramp up whatever equity buying they want to do before that goes into effect. But then could become a negative headwind going forward. Remains to be seen if it makes it into the final bill, and then how negatively it may impact decision making on buybacks at the corporate level. But as you can see, even going back to 2010, the corporate bid has been very significant. So we certainly don't want to see that going back the other direction. So with that, Jeff, maybe I'll kick it back to you here. That's more of the short-term look. Next, we'll kind of hit on the longer-term fundamentals.
Yeah, no, thanks, Cliff. As always, a lot going on between, we're in the midst of earnings, or kind of towards the latter part of earnings season. Like I mentioned, thank you for sharing that. I did leave out that one tax, the extra 1% levied. So again, just another good key point. There's a lot in that in those tax codes that we'll see what happens, and they're continuing to change and adjust. So we'll see what happens. So why don't we? You've got the slide up here with some key takeaways, as you mentioned, for the short term, intermediate, maybe in the long term. So why don't we move? Take us through some of those right now.
Yeah, absolutely. And I think the key here for clients to understand and take away is that markets are completely disconnected. Look no further than Tesla as a great example of a poster child of what's going on. Now over $1 trillion company, accounts for about 3% of the S&P, and is double the market cap of the entire global auto industry on 1% of sales. So just continues to baffle me and move higher. But as we can see, the chart on the left plots the S&P 500 next to forward earnings going back to 94. And I think it does just a great job of highlighting some of the extreme nature that we're seeing out there right now. But even look back at .com 2000, the disparity between the index and earnings was extremely high. But then you look back to where we are today, and it really pales in comparison. And one of the problems, especially for forward-looking returns, is that as we've talked about in the past, valuation is irrelevant on a short-term time period. It has almost no impact on what happens over short periods of time. However, when you stretch out that time horizon and you look out north of 5 years and beyond, that R squared, which is the significance level of how it affects one another, is actually pretty high. And what it's showing now, and we've actually melted up even more, we're at almost 23 times forward earnings today. That shows that forward-looking expectations out over the next 5 years are actually pretty weak. And so you combine that with the interest rate picture, and this is one of the main reasons why we are very bullish on alternative asset classes. But be prepared as you begin to have your year-end or your kickoff meetings with your advisors, as we look at our long-term plans and have to adjust our return expectations. Unfortunately, until we get a bit of a reset, they are going to have to come down. And this is very important because of the Fed. As Jeff mentioned at the top of the call, the Fed is probably top of mind for, I know at least for me and probably for a good bit of our clients tomorrow, as we await to hear the minutes from the meeting and then ultimately the press conference tomorrow afternoon, where we anticipate that the Fed will announce tapering to begin likely either later this month or next month. Why are we so confident in that view, and of the view in general that they are going to now embark on a tightening cycle when for the better part of the past decade they've been tightening? Is if you look at their dual mandate, which is handed down from Congress, there are really two: maximum employment and then stable prices and moderate long-term interest rates. As you can see, if you look at the employment scorecard, the unemployment rate is in line with shorter and longer term averages. Job openings, there are more openings than there are people available to fill them. So we're going to go ahead and give them a green check mark on the employment piece. However, when you look at stable prices and moderate interest rates, it's time, this last sentence here, I think sums it up nicely. Time to take your foot off the accelerator. We've got CPI at north of 5%, PCE, which is their preferred measure, over 4, much higher than long-term averages. And then you've got long-term interest rates, very low levels. They're really across the board. The Fed funds essentially at 0, treasuries at 1.4, compared to 2 and 3. So it's beyond, in our opinion, beyond time for the Fed to start tightening up. Taper will be first. We anticipate that tapering will run from essentially now until July, and then we're likely to see interest rate hikes in next year as well, which we'll talk about here momentarily. Maybe a confluence of the setup that we may want to try and avoid some. So that's the interest rate story. I mean, this chart here I came across as kind of interesting. 5,000 years of interest rates, going back to 3000 BC from the Bank of England. Who knows about the data, but it's just kind of funny to see. But the only 2 periods in time where rates have been this low, the Great Depression in the 1930s and then today. And I would argue, we're nowhere near a Great Depressionary type of economy. So it's time for the Fed to tighten, or else risk the inflation genie, which may already be out of the bottle to a degree, but continuing to wreak havoc on Middle America. This is important again because of the linkage between interest rates and valuations. As we mentioned, north of 23 now on forward. This is a cape that's cyclically adjusted. It's backward looking, but smoothed out for some variations. Clear relationship between low yields and high PE multiples. So as yields go up and we move from left to right on this chart, the trend would dictate that valuations are going to have to come down, which in interesting circumstances also tends to happen in a mid-cycle economy. We talk a lot about the business cycle internally. This is our longer term guidepost that guides our decision making on where we are in the economy. Typically on average lasts from 7 to 10 years, clearly transitioning into mid-cycle where growth is peaked out, profits peaking as well. will likely begin to roll over. Policy goes neutral. This is Fed policy from stimulative to neutral. And then we begin to see a leveling out of inventory and sales. The mid-cycle part of the economy is typically the longest lasting, about 4 years on average. But what we've seen over the last 3 cycles, at least, when we looked at the data, is that transitions to the mid-cycle part of the economy were also set with a resetting of valuations. And so you think about interest rates going up affecting valuations, economic growth now likely beginning to peak and decelerate. We see that on average, in the early to mid 90s, early 2000s, and then early 2010s, on average about a 20% contraction on a price to earnings multiple. And we've done a little bit of that today, but we're right back up here. So we're certainly anticipating some of that volatility that we've talked about last time. Likely going to have to push that the timeline on that a little bit further. And so if the business cycle is the map, the quads are the GPS. So just a quick review on the y-axis is rates of change, again in GDP. The x-axis is rates of change in inflation. We use this model as a GPS to help us navigate, both from a relative risk perspective, so when we want to be risk on versus risk off, and then as well from a sector style factor exposure on both the equity and the fixed income side. So just kind of a quick review here. We were forecasting a quad 4, which is the worst period for equities in the third quarter of 2021. Inflation was pretty sticky and actually ended up accelerating quarter over quarter. You can see the numbers up here up to 5.3 from a 4.9. But then from here, we kind of follow this counterclockwise move, which is pretty typical, coming out of early cycle, where you get a pickup and acceleration in the fourth quarter. This is where we are now. But then likely a slowing into, potentially first quarter is kind of straddling the line, but then really in the fourth quarter, right, is really the time period that's of interest to us as to when we could experience a next significant drawdown. And this is also important because of this graphic here, this little insert that shows when the market is beginning to price in interest rate hikes. So not only tapering finishing, but interest rates moving up coincide with June, the June of 22 meeting. No coincidence, in my opinion, that's when the next quad 4 is forecast, and then also again that transition mid-cycle. When all of these things line up together, right, that's when we really want to start paying attention. Now, that's quite a while from now. Things can and will change between now and then. But just given all of the dynamics, it requires a bit of nuance from a positioning perspective, which, Jeff, I'll just roll right into positioning before turning it back over to you. But what are we doing? How do we think about the world from the equity, from the fixed income, and the alts perspective? Again, gonna pound the table on alternatives here. I think that is the number one pivot that investors can make at this point. Pulling your risk down from an equity perspective, then actually giving yourself a better chance to perform over and above fixed income, from given the inflationary environment. But really the secret sauce is the combination of the 3 of these asset classes. So the traditional equities, traditional fixed income, you absolutely still need, regardless of what happens with inflation and interest rates, they are your buoy to your risk on equity exposure. But really the combination of equity, fixed income, and then alts. Or alternatives, which are assets that have little to no correlation with traditional asset classes. They can not only increase your return expectation over bonds, but also reduce your risk from equities. So giving your portfolio a nice three-legged foundation, three-legged stool in this environment makes a lot of sense. And so on the equity side, we still have that combination of quad 2 exposures and then getting ready for the slowdown. So we've got some things that work well in rising rate, cyclical environments, energy financials, and some commodity exposures as well. But then as we get ready for a growth slowdown, high quality, growthy type of assets do well when growth expectations come down. Some lower volatility kinds of exposures will work well on the equity side. So you'll begin to see some of those kinds of things showing up in the portfolios. With fixed income, we are underweight duration. That's probably the biggest pivot that we have. So we have very little treasury exposure. We're really trying to ratchet down our interest rate risk in the anticipation that rates will begin to rise over time. And then overweighting some satellite kinds of exposures, things like preferreds. We have some EM in there now. We've got short-term, high-yield things of that nature in the portfolios that can give us a little bit more yield, right, compared to the ag, which is about 2%. And by the ag, that's the S&P 500 for the bond market. We're trying to increase our yield, keep our interest rate risk low, but then limit our equity correlation because we don't want things that act a lot like the equity portfolio. And then a quick update: we have also added an additional position in the alts portfolio since the last time that we spoke. So we've got some commodity long shorts, some convertible arbitrage, direct lending, some trend following. And then managed futures position. We've got one more that we're going to be adding here in the next week or two as we wrap up due diligence. So you'll have a nice diversified alternative sleeve as well. And I love this chart. This just kind of shows what we do in a nutshell, from the purpose of each of these portfolios, the name, their targets, and then the correlation. And again, you want to have some opportunities for growth. You want to have some diversification and then some capital preservation and income as well. That's really what having a diversified portfolio that is aligned with a financial plan and your long-term goals is all about. And so with that, Jeff, I will turn it back over to you to take us home and maybe hit on a couple of tax points. Hope to see some folks out on Sunday if you can make it. It's going to be a really great time and a great cause. So thank you all for joining us.
Cliff, thanks for sharing, as always. A lot of information there. We realize it's a lot of information, but again, that's as we continue to talk about. There's a process. The investment team continues to, along with Cliff, continue to navigate us all through this. Right? It's just a reminder for me, Cliff, that we're in good hands when you discuss the process, the quad process that you follow. The rates of change that we're looking at, with earnings, the Fed, interest rates. There's just a lot. We didn't even talk about COVID today, right? We didn't even talk about the virus that is still out there and that has not gone away. We have not talked about the airlines and what's been going on, but there's so many more things we could have added today. As we close out, just a few year-end tax strategies that Cliff mentioned. First, if you do have a high deductible plan, health insurance plan, and you have a HSA, health savings account, make sure you're maxing those out. As a family, you can contribute up to $7,200 to the HSA. You can use it for medical, but you can continue to let it grow tax deferred. If you're over 55, you can make an additional $1,000 catch contribution. You have up until April to maximize April 15th of 2022. But if you can get it done before year end, great strategy to employ. In the time that we're in as we enter the holidays, about giving, helping one another, helping our fellow man and woman and individuals, cash contributions to charity. This year, last year we had the ability to do $300. This year it's doubled to $600. Even if you itemize, even if you take the standard deduction, you can take the $600. as a married couple. If you itemize your deductions, again, great time to talk with your advisor about charitable giving, the use of donor advised funds. If you're over 70 and a half and you have required minimum distributions that have to come out, you can talk about what we call QCDs, qualified charitable distributions, that reduce your taxable income, but help a charity as well. I know I mentioned with Cliff and the investment team, I know they've been working hard and diligently, and we've been filling your mailboxes or your email boxes with confirmations. We've had a lot of gains in the early part of the year. So looking to do a little tax harvesting as we did it throughout the year, but good time, excuse me, to be doing some tax harvesting as we close out the year. So looking at some losses against some of the gains we have in the portfolios. Also, just a reminder, if you're contributing to your 401k or other retirement accounts, make sure you're maximizing those. You're putting in the $19,500 plus the additional $6,500 that you could put in if you're over 50. Make sure you're maximizing and maxing out your IRAs. Again, IRAs and Roths, you may have up until April 15th. But for 401ks, if we don't maximize them by 12/31, you cannot go back. So make sure you're maximizing those plans. And again, with great time to be talking with your advisor with 2 months left in the year, running some tax projections. We have some great tax software we've been using with clients, discussion and showing Roth conversions, contributions to donor advised funds, combining how they could work together. If clients have medical expenses, what their how we could show in offsets or strategies to reduce taxable income. If you had capital gains, we've been watching and running scenarios, potential tax law changes in 2022, how it would look in 2021, right? So there's a lot of projections we could run. So a lot going on. Reach out to your advisor, give them a call, touch base. Let's see what we can do to put you in the best position for 2021 tax year. Cliff, you should continue to share, as I mentioned, a lot through the investment process. We appreciate everything you're doing, and the investment team will continue. And we know you continue to keep us in good hands. Growth of our clients' portfolios is very important, but so is the protection of your money. So there will be times when we're looking through our process and working through our process, you may have a little bit more cash. We may be a little bit more defensive in your portfolios. So just realize there are times we take a defensive stance. And as Cliff mentioned, as we go into the new year, there's a lot ahead and expectations need to be adjusted. We'll continue to talk with you, make sure we're on track with all our plans, but make sure we are aligned with our expectations of what could be happening going forward, given we've now been, which is 3 years. If let's assume 2021 finishes up on the positive, and believe it will, we will have 3 straight years of positive double-digit returns. So it's been very strong years in the market. The Cornerstone team as a whole, we continue to work hard for you all. From the operations team, the service team, advisors, executives, we thank you for the continued trust and confidence you've all placed in us. It's greatly appreciated, and we will never take it lightly. We appreciate working for you all. Again, thank you. Happy Veterans Day. Thank you to all the veterans. Want to wish you all a happy Thanksgiving, happy Hanukkah, Merry Christmas. Wish you all good health and wealth in the new year. We will be back probably Q1 in first quarter to do a Q4 review and update where we will be for 2022. So kind of keep an eye out for that. Again, we'll post today's webinar to our website and we'll put it out via email to you all. Thank you again for being here. Thanks for listening. Be kind to everybody. And thank you. Happy holidays. Thank you all.